Financial ratios are powerful tools. They help us understand a company's financial health. Ratios are like health indicators for businesses. They show how well a company is using its resources. Ratios also show how a company compares to others in the same industry. Financial statements provide the raw data. These statements include the balance sheet, income statement, and cash flow statement. Ratios transform this data into meaningful insights. They reveal relationships between different financial aspects. By analyzing these ratios, we can assess a company's strengths and weaknesses. We can identify areas for improvement in financial management. Understanding these ratios is essential for investors, creditors, and managers alike. Ratios provide a snapshot of a company's financial position at a specific point in time. To get a complete picture, we need to analyze trends over time. This involves comparing current ratios to historical ratios and industry benchmarks. Financial ratios are categorized into 5 main groups. Each group provides insights into a different aspect of a company's financial performance. These groups are liquidity, asset management, debt management, profitability, and market value. Liquidity ratios measure a company's ability to meet its short-term obligations. They tell us if a company has enough liquid assets to pay its bills. Asset management ratios assess how efficiently a company uses its assets to generate revenue. These ratios show how well a company manages its inventory, collects receivables, and utilizes its fixed assets. Debt management ratios examine a company's financial leverage and its ability to meet its long-term debt obligations. They reveal the extent to which a company relies on debt financing. Profitability ratios measure a company's ability to generate profits from its operations. They show how effectively a company controls costs and generates revenue. Market value ratios reflect investors' perceptions of a company's future earnings potential. These ratios relate a company's stock price to its earnings, sales, or book value per share. Let's explore some key ratios within each category and demonstrate their calculation. Liquidity ratios. The current ratio, calculated as current assets divided by current liabilities, measures a company's ability to pay its short-term obligations. For instance, a current ratio of 2 suggests that a company has twice as many current assets as current liabilities. Asset management ratios. The inventory turnover ratio, calculated as cost of goods sold divided by average inventory, measures how efficiently a company manages its inventory. A higher ratio indicates that a company is selling its inventory more quickly. Debt management ratios. The debt-to-equity ratio, calculated as total debt divided by total equity, measures the extent to which a company relies on debt financing. A high debt-to-equity ratio may indicate higher financial risk. Profitability ratios. The net profit margin, calculated as net income divided by revenue, measures a company's profitability after all expenses are considered. A higher margin indicates greater profitability. Market value ratios. The price-to-earnings (PE) ratio, calculated as market price per share divided by earnings per share, reflects investors' expectations about a company's future earnings. A high PE ratio may suggest that investors are optimistic about future growth prospects. Section 4, De Leon, Inc., a case study in financial distress. Let's consider a hypothetical company, De Leon, Inc., facing financial difficulties. We will use ratio analysis to understand the company's situation. De Leon, a furniture manufacturer, has experienced declining sales and profitability in recent years. A review of De Leon's financial statements reveals a series of red flags. The company's current ratio has been steadily declining, indicating a deterioration in its liquidity position. The inventory turnover ratio is low, suggesting inefficient inventory management. De Leon's debt-to-equity ratio is high, highlighting a heavy reliance on debt financing. Furthermore, the company's profitability ratios, such as the gross profit margin and net profit margin, have been shrinking. This indicates increasing pressure on De Leon's profitability. The company's stock price has also declined significantly, reflecting investors' concerns about its financial health. Through ratio analysis, we can pinpoint the areas where De Leon is struggling. The analysis provides a framework for developing strategies to address these challenges. Section 5. beyond the numbers, the importance of qualitative factors. While financial ratios are essential for evaluating a company's financial health, they only provide part of the picture. Qualitative factors such as the quality of management, competitive landscape, industry trends, and regulatory environment are also crucial. For example, a company with a strong management team and a solid strategic plan may be better positioned to overcome temporary financial challenges. Similarly, a company operating in a rapidly growing industry may have more opportunities for growth, even if its current ratios are weak. Therefore, a comprehensive analysis of a company's financial health requires considering both quantitative and qualitative factors. Investors and creditors should conduct thorough due diligence, including industry research, management interviews, and competitive analysis to make informed decisions. Section 6. Charting a course to financial stability. Improving a company's financial health requires a multifaceted approach. It involves addressing the underlying operational and financial issues identified through ratio analysis and qualitative assessments. Companies facing financial difficulties need to develop and implement a sound financial plan. This plan should include strategies for improving liquidity, managing assets efficiently, reducing debt, and enhancing profitability. Improving liquidity might involve accelerating collections, optimizing inventory levels, and negotiating better payment terms with suppliers. Asset management improvements could include streamlining operations, investing in more efficient equipment, and divesting underperforming assets. Debt reduction strategies might involve refinancing existing debt at lower interest rates, restructuring debt obligations, or raising equity capital to pay down debt. Profitability enhancements could focus on increasing sales, optimizing pricing, reducing costs, and improving operational efficiency. By taking a proactive and comprehensive approach to financial management, companies can strengthen their financial health and position themselves for long-term success. Remember, financial health is an ongoing journey, not a destination.